Good morning, everyone. My name is Mike Bevilacqua. I'm the Vice President of the Merrimack Valley Chamber of Commerce. I'd like to welcome you to another Merrimack Valley Chamber of Commerce Next Generation Leaders Roundtable program. May not be too round right now, but we're all here, so it's great to see everybody. I want to thank, first off, Jack Wang, who's going to be doing the presentation today. But I also want to thank our NGL series sponsor, TD Bank, for continuously being the sponsor and supporting these programs. So I just want to quickly turn over to Parker Williams from TD Bank to say a few words, and then I'm going to tell you a little bit about the chamber before we get started. So Parker, thank you for joining us.
Mike, thanks so much. I appreciate it. As always, TD continues to be so happy to be able to sponsor this event. You guys do such a great job with these. Great speaker after great speaker. I've enjoyed every single one of these I've been able to attend. And I'm excited for today's to hear from Jack. I think it's a great subject. It's a very important subject. And I think it actually really fits the mold well of next gen leadership. You want to be able to get yourself right financially in order to be able to be successful in your personal life, be successful in your career. So I think it's a great topic, and I'm very interested to hear what Jack has to say. So appreciate it.
Perfect. Thank you very much. We appreciate your support and everything from TD Bank as well. So thank you for joining us today, Parker. Before I turn over to Jack, I just want to mention a few upcoming Merrimack Valley Chamber programs. We have webinars running through April. Our next Young Professionals Next Generation Leaders program is going to be taking place on Tuesday, April 13th. It's going to be from 10 a.m. to 11 a.m. and it's with Brian Kaplan, who's a Grow with Google speaker. He's also a speaker on LinkedIn as well. And he's going to be talking about how to make LinkedIn work for you. I know I really don't know how to make LinkedIn work for me, so I'm looking forward to that program. It's free for members as well, so we look forward to seeing you at our next Generation Leaders program. I also want to mention that the Merrimack Valley Chamber is going to be going back to in-person evening mixers in late April and May. You'll see the details on those shortly, but we look forward to seeing you there. We'll also continue the virtual mixers also and the virtual programs. So there's something for everybody. We look forward to seeing everyone again. And before we turn over, I just want to mention one program, which is our big Spring Virtual Business Expo. I want to thank Rand for really helping us with this. She's got a great platform for it. You want to mention it all, Rand, before we get going?
Yeah, absolutely. We're really excited this year because the platform allows for as much of an in-person event as possible, where you literally get to move yourself from table to table as if you were walking from booth to booth. And it's on a video screen, so you're still talking to somebody as if it is right here. So I could walk up to Rebecca's booth for Salem 5 and start talking to her, and then, okay, I'm done with her, I can jump on Parker's booth. So it's going to be that nice networking. We're really excited about it.
And all you literally simply do is you're going to sign into the program. You're going to see the booths. You'll see Rebecca's booth. You'll see Parker's booth. You click on their booths. You're right there talking face to face with them. No one else is in the conversation. So we're really looking forward to it. It's going to be free to attend. So it's completely free to attend the expo. If you visit 3 booths, you get entered into our prize raffle. We got some great prizes. I think an Echo Dot that Andy Furman, who's on the call, provided for that. I want to thank him for his sponsorship with the expo. But again, next Wednesday, April 7th, 1 week from today, it's going to be running from 1 to 3 p.m. Again, completely free to attend, and we'll enter the link into the chat box. You'll see that later. And also, immediately following the expo, we have our virtual networking program, speed networking style, at 3:15 to 4 p.m. So really a great opportunity to get out there, make new connections, learn about great products and services right here in the Merrimack Valley. And we look forward to seeing you next week. But with that being said, I want to thank everyone for joining us here for our Next Generation Leaders program today. And I want to turn it over now to Jack Wang of Longhorn Financial for being the guest speaker today and having a great topic to talk about. So with that being said, thank you, Jack, and welcome.
Awesome. Hey, Michael, thank you so much. And thank you, everyone, for being here. I really appreciate this. So Parker, from TD, so years and years ago, I was a commercial lender. And I started my professional career in banking at a smaller institution called Andover Bank, right in Andover Center, which not long after I left was acquired by TD. I didn't leave because it was acquired by TD, but just so I have that banking background. What I want to do today is really kind of just talk in general terms and hopefully give you some ideas of ways to think about tackling the question that I often get and that you often may be asking is, well, listen, I only have so much money to go around. So do I save for my future or save for whatever, or do I pay down debt, right? And this is true whether you have a ton of student debt, or if you have a lot of credit card debt or car loans, or whatever the case may be. It almost doesn't matter. And so I want to just talk a little bit today about some ideas that you may not have thought about before. I mean, we're not like breaking new ground here, but oftentimes what happens is, well, if I need to lower my payments on debt, I need to run to the bank and just refinance, right? Or find a lower interest rate, or things like that, right? That's pretty common in the mortgage space. Let me refi. I'll go back out to 30 years. I'll lower my rate down to whatever, my payment will go down. Okay, and you can certainly do that, right? That's not a problem, but that's not the only way to do it. I'm also going to touch a little bit on student loans. Just right now with the moratorium on payments, um, there's actually an opportunity, because often a question I get asked today is, well, I'm not required to make any payments, but should I? And we'll talk about a strategy there as well. So in interspersed, I'm going to have some case studies. And as I mentioned earlier, if you have questions, please just jump in, or if you want to chat in, please do so. But again, thank you to the chambers. Thank you to the sponsors. So let me go ahead and go ahead and just launch this up here.
Are you sharing your screen, Jack?
Yes, if I can.
Yep, I gotta make you a co-host. Okay, you should be all set now.
Awesome, thank you. Okay. All right, I just need a thumbs up or a chat, or like okay, great, you can see that. Okay, thank you, right? By the way, just a quick aside, I did this presentation for this group down in Virginia. This was a couple of weeks ago. It was actually around college financial aid, and they had actually run Facebook ads, got a whole bunch, like they had like 80 people registered. And I'm doing the presentation like this, and something happened. So I'm just talking, giving great information. And I didn't find out till afterwards that someone didn't hit the actual present button. So I spent an hour talking during a presentation to nobody. So no, right? They spent money on Facebook ads. They got all these registrations. Nobody actually saw it. So, so just like I'm more aware that like, yeah, you can see this. Yeah, this is good. Okay. So let me just go through here. So one thing that I do want to talk about when we think about paying down debt, right? This is really the question that often people get. And so as I go through this, I'm going to talk about some debt strategies, and I'm going to highlight some ways where you can kind of find some money to save, um, because it's not one or the other. And so honestly, this is a very common question. Do I start my highest interest rate? Do I start whatever? And it really depends on what your goal is, right? We think about finances, I want to save for a car, I want to save for a vacation, I want to save for retirement, and how you invest is somewhat based on the time to that goal and what you want to do, right? But when we're talking about debt, there should also be a goal. And oftentimes people just say, okay, well, I want to get out of debt. I want to get out of debt. What's the best way to get out of debt? Okay, those are great questions, but really ties back to this. So for example, is your goal to just simply pay the least amount of interest? Right? And some people say that that's what it is. And okay, and that's fine. Or is it to get out of debt in the shortest amount of time? Because those are actually different things. All right, you're gonna see that in just a moment, right? Or is it, or perhaps you're trying to free up cash flow so that because maybe your money's really tight every month, so you don't really care about paying down all your debt. You just care about sort of getting at least like the fastest one, whatever the fastest one's paid off, so you freed up that monthly payment. Okay. Or is it something else, right? So first thing you got to think about, like, what are you actually trying to accomplish? Because they are all different things, just like any other goal that we might have. And you'd be surprised, by the way, when I ask this question, oftentimes people say, well, of course, come on, Jack, don't be stupid. Like, it's of course to pay the least amount of interest. But then when you dig into it, it's like, no. What they actually meant was, I want to get out of debt like as soon as possible. So you want to be clear on that. And so when we talk about first sort of attacking the debt problem, right? There's actually more than two ways. So So the two most common ways that you may have heard of is one is you want to pay off the debt with the highest interest rate. Now, these aren't wrong, right? This is not the wrong answer. I mean, this is can certainly be the right answer for you. But that's one way. And the other way, by the way, is to tackle the one with the smallest balance. Okay. But those aren't the only ways. And by the way, I'll just interject here. So for those of you who may have heard of a little tiny research organization called, Harvard University, they actually did a study on this several years ago. It was actually published in the Harvard Business Review, their business school magazine, and where they tried to figure out the best way to pay down debt. And the answer that they came up with was this paying off the debt in the order of the balance, starting with the smallest one, but not for financial reasons. The reason that they found it was actually the best way was actually far more psychological, in that if as you pay down a small debt, you now see the progress. You're more likely to stick with it, even if you end up paying a little bit more, it takes a little bit longer, whatever the case may be. But the research was actually pretty clear on this. So again, that doesn't mean that that has to be the way that you do it. It just, for people who need to see that progress and feel that progress, that might be a way. But it's not. But these two aren't the only ways. There are four others. So, for example, you could pay down the debt with the fewest number of payments remaining, right? So it might not be the highest rate, it might not be the smallest balance, but you might only have 3 payments remaining. Okay, right? You may want to prioritize that. You could do something like the highest payment amount, right? Let's get the biggest or the highest payment amount paid off first so that I can free up that cash every month. Whatever. There's a number of other ways. So it's not limited to just these two. Okay. But here's the thing. Remember those goals I talked about, right? Like least amount of interest or shortest amount of time or something else, right? What you actually find is that depending on what your goal is, leads to a different strategy for doing it. Okay, so if your goal is truly to pay the least amount of interest, that generally, I say this very broadly, but generally means that you're paying down the highest interest rate first. Generally, not always, but generally. But if your goal is to get out of debt the fastest, that's actually generally the smallest balance first. Again, not always, but generally, right? So here's a real life example. Okay, so this is a real case study from a real client that had $208,000 in debt. So, and for most of you in the area, so how they got to this debt? So actually, on the credit card side, it was like over 100,000. So just imagine if you go to the mall, right? Pre-pandemic, you go to, depending where you are, like I'm in Westford, so I could go to the Nashua Pheasant Lake Mall. For those of you over closer to where the Chamber's office, maybe you're going up to the Rockingham Mall. And just imagine for a moment that you walk around the mall, right, both floors, and you just do 2 laps, right? 1 lap around the top floor, 1 lap around the bottom floor, and you go into every single store that offers a credit card. You get the credit card and you charge it up, right? Just imagine if you did that, right? So that's this family. They had a stack of credit cards that was like multiple playing cards decks thick, right? Like you could like deal blackjack out of this thing. It was crazy, all right? And literally, I'm in my mind, I'm like, all right, you must have just done a couple laps around the Rockingham Mall. Just like, how do you end up with this? So paying off using some of these strategies, now you'll notice that there's 2 really low bars, right? This is total amount of interest that this family would have paid over time. But had they paid off the highest interest rate debt first, they would have ended up paying something like 45,000 or so in interest. But if you notice that it's not always that different. Had they gone with the smallest balance first, they would have only paid a little bit more in interest. It actually wasn't that big of a difference in this particular case, okay? So I just want to show you this as a case study. However, when we get to time, it's a completely different story. So the blue bar is measures in years, how long, using some of these strategies, how long they were going to pay off $208,000 in debt, okay? Not counting their mortgage, right? We always save that for last. So the blue bar measures in years. So most of them, so everything's 8 to 9 plus years range. But the orange bar is when they could pay off their very first loan. Remember, it's all about these goals, right? What are you looking to do? And here you can see some real differences. So for example, the highest rate, had they prioritized the highest rate first, it would have taken them just over 8 years to pay off debt, but actually would have taken them 11 months to pay off the very first loan, right, which was the highest rate. But had they gone with the smallest balance instead, to pay off the overall debt still would have taken the same 8 years, but they actually would have gotten their very first loan paid off in 3 months. Right. So again, depending on what your goal is, right, it made a significant difference. So what's really unseen is that had this family started out with the smallest balance way of doing it, they actually would have had 3 of their loans paid off before the first payoff using the highest rate strategy, right? So the interest cost didn't really matter that much. The time didn't really matter that much. But if you're in a situation where you are looking to free up cash flow, or you are someone who just needs to see that progress, right? In this case, the smallest balance would have been much better. The highest interest rate wasn't bad either. That was the second best choice, but the progression just would have been different. Now, please don't misunderstand. I'm not advocating that this is the right way for everybody. What I am saying, however, is that you want to look at this to find out what the best way is for you based on whatever your goal is. Right? Now, how do I find some extra money, right? So this is kind of what people often ask me, like, okay, this sounds great, Jack, but like I'm like literally looking for, change in my couch cushions, and I'm eating ramen noodles every day, right? Like I can't do this. How do I find extra money? Okay. So if you Google on the internet, right? Here are the common tips. And so this is why I'm here to kind of just give you some other ideas. So you can always spend less on food, right? You can be entertained for less, right? Again, it's a little bit different in the age of the pandemic. So people talk about, well, instead of going out to the movies, rent Netflix, right? Even better, what you want to do is you want to bum a Netflix login off of your friends, so you don't have to pay that like $7 to $9 a month, right? Like that's the real key here, right? Okay, which by the way, I think they're changing the rules on number of logins you can have. But anyway, right? So, we can get pretty creative with this stuff. And so this is the common stuff. And here, like lower your housing costs. Of course, you can refinance your mortgage, get a roommate, rent out a room in Airbnb or something like that. And cut your cable costs and stuff, which of course really works out well if you bum a login off of somebody else's Netflix account. So these are all the common tips, and that's true, but I want to share with you something, all right? Just something to think about. So if you think about a lot of times when people are trying to get out of debt and they do have a little bit of extra money, you often hear people say like, well, I pay a little bit extra on this loan, and I pay a little bit extra on this loan, and I pay a little bit extra on this third loan, and kind of scattershot, all right? So if you pay extra on the loan, true or false, if you pay extra principal on the loan, do you save interest? The answer to that is, of course, true, right? You're paying down principal faster. You actually pay less interest. This is no different than like paying extra on your mortgage, right? True or false? By paying extra, does it save you time, right, to pay off the loan faster? The answer to that, of course, is also true. Right? You're paying extra principal every month, so you're going to pay off the loan faster. Right? So these really aren't that confusing. However, here's the question. Is paying extra on the loan worth it? Totally different question now, right? And I'm going to show you why in just a moment. So here's a case, and let me walk you through this, just so everybody understands. So this is that same case, the family, the $208,000 debt. We're using a strategy called debt stacking, which is basically as you pay off each loan, you take that payment and you apply to the next loan and the next loan and so on and so forth, okay? So let me walk you through this. So the original payoff was here. we're going to use the strategy of paying off the smallest loan balance, which is going to be here. Okay. But I looked at what if, just, let's just kind of dream crazily here, right? What if we actually paid less on a loan? Meaning, and I don't mean like, not paying the minimum payment, right? Because the bank, like, the people at TD want you to make at least the minimum payment, right? So I'm not talking about doing less, okay? What I'm talking about is all those little extras, right? An extra $10 a month here, an extra $100 a month here, whatever. What if we started backing off on those, right? And actually started paying less, okay? What would actually happen? Well, in this particular case, if the sorry, so I looked at a couple stars. So this family is paying about an extra $1,000 a month across different loans, right? Extra 100 here, 200 there, whatever. So I said, so what would happen if we just backed it off by $100, right? So instead of paying an extra $1,000 a month in extra principal, what happens if we just take it back $100, right? Go down to 900. Well, so if you look in that minus 100 column down below, okay, you can actually see that by paying a little bit less aggressively on principal, they're going to pay a little bit more in interest. But over time, this is only $803 of interest. So not $803 of interest on $208,000 of debt, not exactly a big deal, right? But how much time was it really going to cost them? It was only going to change their payoff by, actually, I'm sorry, this was a different case. This wasn't the 208,000, but in this particular, this was, I think, still about 100,000. So in this case, it was only going to cost them an extra month. Now, if you look at this, right, on the other hand, if you look at the $500 column, the minus 500, yeah, it's going to cost them an extra almost $3,600 in interest, but it's only going to cost them an extra 4 months. It really wasn't that long. So paying extra principal on these loans really didn't make that big of a difference. Now, on the other hand, let's sort of go the other way, right? Instead of taking money back, right? What if we threw an extra $100 on top? And so instead of paying an extra $1,000 a month, we paid an extra $1,100 a month. How much would that actually get them? Well, in this particular case, they were going to save a whopping $479, and they were only going to shave 1 month off. So it really wasn't that much. So what I'm saying here is that one strategy for finding extra money to save, right, to save versus pay debt or whatever, right, might actually just come from how you handle the debt themselves. It is not about bumming somebody's Netflix login. It is not about getting a roommate. It's not about, how low can I go on my grocery budget? I mean, those things are all good, and that's fine, but those aren't the only places. This is about being more efficient with your money, right? Understanding what the real impact is. Now, you have to decide as the borrower, you have to decide whether it's worth it to do these things or not, right? That's the point. But, is it easier for you to find 500, to back off your extra payments by $500 a month? Or is it easier for you to find $500 a month somewhere in your day-to-day expenses, right? And so it's funny, I see someone just took a sip of coffee, right? That's sort of like pre-pandemic, like, hey, like the standard advice, right? Like don't go buy coffee, right? So if you knock out coffee out of your budget every day, can you get to $500 a month? I don't know. Maybe not, right? Sorry, I didn't mean to pick on you, just happened to see it out of the corner. I do the same thing. By the way, I go to Starbucks, I go to Dunkin' Donuts. Actually, the bane of my existence, to be honest, is I drop a ton of money at Cumberland Farms. Okay, like I'm just gonna admit it. There's times where I need to go get gas, but I'm so ingrained that I pull into the parking lot. I start walking into the store to go buy snacks, and then realize, oh, I'm actually not here for a snack. I was actually here for gas. so I get it. Okay. Now, a word about student loans. Right now, student loans federal student loans, I should say, are under the moratorium. So there's no interest, no payments. So people often ask me, well, should I be making a payment? Okay. And this is a real client. This client is from Ohio, has 4 federal student loans. You can see the balances, you can see the monthly payments, and you can actually see the sum of those payments is almost $1,400 a month, or over $1,400 a month. Okay. So his question to me was, well, should I be paying these, right? I like I could use the breathing room, I could use it to build up my savings and stuff. And so what I say to people is, yeah, you can, again, here, you can be, excuse me, you can start paying if you have the money, but you can be smart about it, right? So if he started just paying back the $1,400 a month, you can see how the $1,400 is allocated among the 4 loans. What I told him was, look, if you really want to pay the $1,400 a month, why not focus your efforts? Payments aren't being taken right now anyway. But if you have the money you want to pay, why not throw all that $1,400 at that smallest loan? Right? This was last year. So what ended up happening is throwing $1,400 at that loan. Now that loan number 3, that $10,500 loan, that's been paid off. Right? So now that's another $117 that he's freed up in his budget. So it gives him a little bit breathing room. Right? So if you have the money, you can be smarter about this and just sort of really focus your efforts, right?
Hey,
Now, what happened? Yeah.
Sorry, just a question. So for somebody like this, where the extra money could be used, say, in otherwhere in their life, what about just paying like part of a loan?
Yeah, absolutely. These things are not all or nothing, right? So in this particular case on this screen, since we're here, if this person couldn't really afford the $1,400 a month, but let's say he was willing to do $700 a month, right? I would have given him the same advice. No payments right now. Let's take the $700 a month or $500 a month or $200 a month or whatever that number is, but let's really focus it and let's make it super efficient. And in his case, he really wanted to create the breathing room in his monthly cash flow. So instead of taking whatever numbers, spreading it out among loans, let's hit it hard on one loan and get that first loan paid off. And you'll notice coincidentally here, it happens to be the smallest balance again, right? But that's more coincidence than anything else. But that's a great question. It is not an all or nothing thing. In the prior example where the family backed off their payments $500 a month, they don't have to, right? That doesn't mean they have to go spend it. They could take 250 and save it, and 250 still, or add it to your lifestyle, go out to dinner once a month. I mean, whatever, right? It's not an all or nothing thing. But these are just kind of some of the basics that I want to share to have you guys think a little bit differently about this. Okay, great question. Great question. Now, let's talk a little bit about, let's talk about sort of, and you can kind of do this with other types of loans as well, whether refinance a mortgage or even refinance a car loan or just stretching out payments on a credit card. Often people think about, well, Jack, I'm 15 years into my mortgage, but I need to free up some money so I could refinance the 30 years, but I don't want to be stuck with my mortgage for the next 30 years, right? Like I want to be out of debt eventually. Same thing for a car loan, right? Whatever. And I understand that, but we're gonna take advantage of the banks a little bit here, and because most banks don't charge prepayment penalties on most loan types, just because you have a 30-year mortgage or a 20-year loan or a 10-year car loan. I mean, I don't think there's 10-year car loan. I hope there aren't 10-year car loans, but like a 7-year car loan doesn't mean you can't pay it off early. So let me give an example in a student loan, all right? So in this case, this is a student loan, but this could easily apply to a mortgage. So you can change the repayment plan, refinance, go from a student loan, typically 10 years, and you can refi out to as many as 25 years. And so, of course, when you refi out, your payment goes down, right? But instead of just spending that money or whatever, what if you saved it instead? What would actually happen? Right? And let's just say arbitrarily that you earn 2% interest, right? Just again, not trying to sell you anything here, just it's the idea. So what would actually happen? So let's take a look if my, computer actually wants to. Okay, here we go. All right, a lot of lines here. So that 10-year line, okay, so this is actually a client, it's a 150,000 student debt in this example. This again could just be just as easily on a mortgage. The blue line is what the balance will look like over 10 years, right? And after 10 years, it goes to zero. The orange line is that they took out the same loan, but they did a 25-year repayment. So obviously you can see that the line goes out a lot further. But the 25-year payment, of course, is a lot less. So what happens is if you take that difference in payment and you simply save it, right? And again, we're assuming a 2% rate of return here, but just what would happen if you save it? So if you save the difference, that gray line is that balance, okay? It starts to go up. And the reason it kind of tails off is because after 10 years, you're not really saving the difference anymore, not nearly as much. But if you notice where the gray line crosses the orange line, the gray line crosses the orange line, so you actually have enough in your savings account or whatever other vehicle you chose to save it in, so that you could just write one big check and pay off the loan in 12 years anyway. And so let's think about this for a moment, right? Let's think about what this actually means. Like, wait a second. So Jack, I could have paid off the loan in 10 years, but instead it's going to take me 12 years. Okay. All right. Did you pay a little bit more in interest? Yeah. All right. But doing this, you could have saved that money the whole time. Now think about what happens before the 12 years, right? As the gray line's going up, right? These are the things that get people in trouble. Like, okay, if you focus all your energy on paying off debt and have no savings, then your car breaks down, right? Your fridge goes. You need to replace your roof, right? All of those things that happen to us in real life. Well, if you focus exclusively on paying down the bill on the loan and nothing in savings, and then something else happens, how are you going to pay for it? You have to go back into debt, right? So you just, when one of those things happens, you end up undoing the hard work that you did. So in this type of strategy, right, the gray line, which represents savings, actually gives you an opportunity to kind of account for those things that happen. But if nothing of those happen, you're still out alone in 25 years, even though what we're doing is we're taking advantage of the 25-year payment, but we're still intending to pay it off as quickly as possible. Right. So again, this is just simply another strategy. I'm not saying that this is what you have to do. This is just an example. So if you really think about this now, all right, so when you really think about this, we talked about sort of backing off on extra payments potentially, or being efficient with your money and how you target payments, or using sort of refinancing to your advantage, right, and take advantage of the fact that student loans and mortgages don't have prepayment penalties, right? These are different ways that you can come up with extra money each month and be able to save it while you're paying down debt, right? And you didn't have to necessarily cut back on your lifestyle. Like you didn't, like in my case, like you didn't tell me, hey, Jack, you can't go to Cumberland Farms anymore, which quite frankly would be the death of me, all right? Okay, I mean, I'm just speaking the truth here, that's just the way it is. So if you ever want to buy me something as a gift, you know where to go, Cumberland Farms. But you want to look at your overall finances, right? You want to consider, I mean, how you do this. You want to consider these things. You want to balance these things out, right? I will tell you that even beyond this, this is a like emotional versus logical tug of war, right? The logical side of you says, oh yeah, of course I should do these things. The emotional side of things may not be the case. And so the reality at the end of the day is people end up doing something in between if they're going to do something at all. Like, I don't want to devote all this extra money to pay off. I really want to, take a little bit of money to pay off loans and a little bit of money to save, or a little bit of money to loans, a little money to save, and a little bit back into my lifestyle so I can go out to dinner once a month, right? The reality actually is kind of in the middle. Very few people that I work with go one extreme versus the other. But you have to find the right answer for you, and it's far more of an emotional decision than it's a logical decision or even a financial decision, quite frankly, right? Because the numbers are what they are. It's can you hack it, right? Emotionally. So, right, it's not just about the numbers, right? But just keep in mind, again, we talked about this. It's not just debt, right? This has to really be handled sort of in your all aspects of your finances. So, for example, that student loan scenario that we just showed, like if you already have a huge emergency fund, then maybe you just pay off the student loan in 10 years and just call it a day. Okay, fine, right? But if you don't already have an emergency fund and you need to build one up, then maybe what I showed you makes some sense, or maybe some other strategy, right? So it's not just, don't think about just, oh, I gotta get out of debt, I gotta get out of debt, right? It's how is your financial picture overall? That's only one piece of it. And don't forget, it also goes back to that first question I asked is, what is your actual goal here, right? And if you remember, it's, right, do we want to get out of debt like, highest, least amount of interest, shortest amount of time, pay off the first loan the fastest, something else, right? Tax considerations also come into play here. For those of you mortgage debt or home equity debt, if you have enough to where you can still deduct the interest on your tax return, that obviously has to play a part here. So it's not as simple as just, oh, it's this loan and that's it, all right? So I want to take a moment, and I'm happy to go over other examples and talk, but I also want to take a moment to make sure that I have your questions answered. So please feel free to just unmute and just chime in. Otherwise, I can go over a couple of things as well.
Hey Jack, it's Parker. So
Yeah.
I assume you'd advise generally like prioritizing debt that doesn't directly support an underlying asset, I guess. Like, I mean, the main thought is a house. That's probably the best example where a payment of additional principal on your house is in some ways effectively adding to long-term savings. It's not quickly realizable cash, but assuming all goes well, your house should at least hold value or God willing appreciate. So long term you'll be able to recognize that cash back, whereas with a credit card debt, you probably went to dinner or something like that. There's no tangible asset that you can actually sell, or even a car. I mean, you have the underlying asset, but it's likely it's probably depreciating more quickly than the loan balance in many cases. Would you agree? Is that like typically how you would approach it?
Generally, this is really where all of your finances really come into play. So I think most people, right, if you look on the internet, most people would generally agree that credit card debt bad, right, mortgage debt good, right, whatever those terms mean. And so it really depends, because, for example, I might tell a client who, let's say, has credit card debt at 0%, right? Let's just make an extreme 0% debt on the credit card. I might tell that person to really focus on paying down the credit card anyway, even if the credit card was going to stay at 0%. Here's why that might happen. If this person doesn't have an emergency fund and it's going to take a while to build it up, I might focus on paying down that debt, even if it's at 0%, because in the short term, that credit card might have to serve as the emergency fund, right? Because if you pay down a mortgage, right, like to your point, Parker, is that it's not readily accessible, but it is a good long-term store of value. But if something breaks, you can't just walk into TD like, hey, I have $100,000 of equity in my house. Can I please have it? Right? Like, it doesn't quite work that way. So there are different scenarios where I might recommend something that might go against conventional wisdom. But as a general rule of thumb, though, Parker, you are correct. Now,
Jack, another one just that kind of goes against unconventional wisdom that you and I have had a conversation about just in passing is that even though like a car may be paid off, maybe refinancing the car might be better to pay off the other stuff, if you want to talk about that.
Yeah, absolutely. One of the reasons why the truth in banking, right, is when banks charge you interest rates, as is a general rule of thumb, right? It's based on risk. right? And so, you look at things like debt to income ratios and credit scores and credit history and all that stuff. And also, is there underlying collateral? Because if you don't pay the mortgage on your house, eventually the bank will come for your house, right? As opposed to a credit card, you borrow that up, right? It's generally higher interest rate because if you don't pay, there's nothing the credit card company can come after. So there are times where it might make sense to refinance your car, right? Maybe you got your car paid off because you emotionally like, oh, I should never have a car loan because it's a depreciation asset, right? But it might make sense to use your car as an asset to get a low interest rate loan on your car and use the proceeds to actually pay off a higher interest rate loan credit card, right? That happens. In fact, there's also this is also another strategy that's not commonly utilized. And Parker, I don't know if you want to talk about this. I don't know if TD does this or how often you see this. But people say like, yeah, I have $10,000 in credit card debt, but I have $10,000 of cash in my savings account because I want to hang on to it. Understood. But there are ways where you can do what's called a savings account secured loan or a CD secured loan. And yeah, it does tie up, you can't access the cash, but you can get a really cheap interest rate because for the bank, it's ultimately very low risk because if you don't pay, they take your account, right? But as you're paying it off, it reduces the lien on the account, which then allows you to access the cash. But you could end up using that strategy to get a really low interest rate to pay off a higher interest rate loan and still ultimately get access to your cash as the loan is paid off. So I recommend that quite a bit. It's actually a good strategy for a lot of people, but I will say that's a strategy that's not commonly known by most people. That's a good one. People ask me questions like, "Hey Jack, I want to buy a car. Should I take out a car loan?" Um, you read a lot about don't ever take out car loans, right? If you have the cash, buy, just use the cash. But cash isn't free. So again, it depends on your situation. So just let me turn this question around on you. Okay, so let's imagine for a moment. Right? I'm gonna stop my share for just a moment. Okay, so I can see all of you. I know some of you have your cameras off, but there's what 13 of us on it, right? So let me just imagine this for a second. I'm gonna come to you. I'm a financial advisor. I'm gonna say, hey guys, listen, I'm gonna sell you an investment. Right? This is gonna be great. All right, I'm gonna sell you an investment that's guaranteed to go down in value every year, and it's going to cost you to hang on to it every year, right? But it's an awesome investment, and you can use the emoji, the reactions in Zoom, right? And you can give me a little high sign. How many of you would take that deal? Like if I said to you, like, I'm going to put you in an investment that's guaranteed to go down, and it's going to cost you a fee to take that deal every year. How many of you would take that deal? Right? Yeah. Well, there you go. Right. One person. Thank you. My token card guy. Right. As a financial advisor, if I made you that pitch, A, I'm probably getting fired. B, I'm probably getting fined. And C, I'm probably going to jail, which is really going to cut into the Cumberland Farms thing. All right. But didn't I just describe a car? Right? Like unless you're buying an antique or you're buying a Ferrari or something, right? Like limited edition. I just described a car. So there are times where if you can get a car loan for like a really low interest rate from a bank or through the dealer or whatever, but you have the cash otherwise invested or whatever sitting there, you may actually want to take the car loan, I should say, right? And you're essentially transferring that depreciation risk to the lender, of sorts. So so again, the common wisdom is, oh yeah, don't ever take the car loan. Pay cash if you have it. Just be done with it. That's not always true either, right? It just depends on your overall situation, which is why I said at the end, you can't look at debt in a vacuum, right? You have to consider your overall finances. Other questions? I will just say for the college thing, because I do specialize in that, sometimes when families have to borrow a lot for college to send their kid to college, I will sort of half jokingly say, if you borrow to send your kid to like BU at 78 grand a year times 4, right? I'll say like, it actually is cheaper if you just forget the college thing and just buy your kid a Ferrari. Right? Like just buy your kid a Ferrari, hand the keys, and just let them drive to wherever they want, because it actually costs less money. So, so just something to think about. Other questions?
And if anyone has any questions, you can just unmute yourself or just type in the chat as well.
I was gonna say, Rebecca, now you know what to get Gunner.
But yeah, I mean, this is, I'll just say this one last thing sort of in closing. Oftentimes, what do people focus on when it comes to loans, right? It's the terms, like the repayment time, and the rate. And those are obviously important. But at the end of the day, it really has to fit your finances, right? You hear stories right now about mortgage brokers where they're like, a 30-year mortgage is like, 3% or whatever it is today. And there's people out there holding out for like 2.9%. Okay, to which I say, okay, that's great. They'll save you like $1 on your month, but let's not get greedy here. All right. Like, let's just kind of take a step back and just have some context. The rate is important, but it's really not that important. If you're taking advantage of some of these other strategies that we've talked about or whatever, there really isn't much of a difference between a 3 and a 3.5% rate or a 3 and a 4% rate, right? Yeah, it costs you a little bit extra interest, but it's really not that big of a deal when you're using some of these strategies. It has to be right for your overall situation. It has to fit your overall situation, which has a much greater impact than what the rate is. And a perfect example of this right now is in the student loan space, right? Federal student loans during the pandemic, no payments, no interest. But for all the people who took out private student loans because they were initially, right, enamored with the low interest rate, they're still having to pay, right? Because the federal moratorium didn't extend to private student loans. So yeah, the federal student loan interest rate was a little bit higher, but now it's been zero. I mean, granted, we had to have a pandemic for this to happen. That's not so good. But having said that, it's been zero for like a year. Not so bad, right? So don't get hung up on the rate all the time. Okay. And with that, thank you. So you guys probably know a lot more about me and my eating habits than you probably would have expected. So really, what this means is that we got the weather report from the chamber. And I'll see you all at a local Cumberland Farms. I mean, that's
Yeah, we're gonna have to have a live event at Cumberland Farms apparently. So, but no, I just want to say thank you to Jack again. We appreciate you. This great presentation, something we can all take back from it. So thank you again, Jack. We appreciate being part of this program. I want to mention also that again, the Merrimack Valley Chamber of Commerce. First off, I want to thank Danielle and Rebecca, who were both on the call today. They're both part of the NGL Ambassador Group, so thank you. And we have some great events coming up. As I mentioned, our next NGL event is going to be taking place on April 13th. It's how to make LinkedIn work for you. Again, I have no clue how to use LinkedIn. I just click accept and then move on. So if you want to attend that event, it's free to sign up. You can go to merrimackvalleychamber.com. I think Rand will include that link in the thank you email out as well going out shortly. And also, again, next Wednesday, 1 week from today, 1 to 3 p.m., we have our annual virtual Spring Business Expo Health and Wellness Fair. It's going to be a great opportunity to see some new products, services, talk to different members, and have a chance to win some great prizes as well. I want to thank Andy Furman and Furman Insurance for donating an Echo Dot. If you visit 3 booths, you get entered into that raffle. You could win that for free. So again, next Wednesday, April 7th, 1 to 3 p.m. It's going to be an exciting platform. Thank you to Rand as well for getting that set up for us. And then again, right after that, if you want to do some networking, we have virtual networking immediately after the expo also, but a whole host of great upcoming events, in person, virtual, in between. You can find out more information on merrimackvalleychamber.com. If you ever need anything, feel free to contact us at the chamber. We're here to help. We want to say thank you for joining us today. Thank you to Parker and TD Bank for their sponsorship, and thank you to Jack for the great presentation. But enjoy the rest of your afternoon, and we look forward to seeing you all soon. Thank you again.
Thank you,
very
everyone.
much. It was a great
Thank you.
presentation.
Thank
Thank
you.
you.
Jack, for the presentation. Nice seeing you.
Thanks. Yep.